Can you state your name, your title, and company?
Yes. Oh, I should do it.
Oh, please.
Yeah. I'm Jim Grant. I'm the editor of Grant's Interest Rate Observer, and what I do for a living is write. I want to interview famous people, but who are famous perhaps for reasons that the public is not fully aware of. I hope to elicit from them new thoughts, frank admissions of things that they had not previously admitted to, and I want to get them to laugh once or twice. With me today is Alan Fournier, who is the founder and chief investment officer of Pennant Capital Management. Alan is one of Wall Street's storied money makers. He's been at it 30 years, and we are about to hear how he goes about this very arcane and difficult business of buying low and selling high. Sounds easy, doesn't it? Well, let's go find out. It is a pleasure to be with you today. You're Alan Fournier, I know that, and I am Jim Grant, I know that too. And,
Thank you, Jim.
Alan is the progenitor and chief investment officer, and for all I know, the president of Pennant Capital Management.
Correct.
And we have known each other, I think, for the better part of 15 or 20 years. Certainly, I've known of you for a long time.
Paid up subscriber.
Oh, what was that, Alan? I want to first begin by acknowledging a long overdue debt of gratitude to Alan Fournier. In 2006, we got an email. Email then was a kind of a cutting-edge technology. And in this email was documentation pertaining to something called, and I read it, the witness will now consult his notes, inside the ACE Securities HEL Trust Series 2005 HE5.
Correct.
Which most arcane and recondite words and numbers pertain to securitized mortgage proposition, kind of a science project of home equity loans, no doubt subprime.
Correct.
And it was the first solid intimation that we had at Grant's of the impending clouds, soon to be thunderstorm, soon to be Noah's quality flood. So thank you, Alan. It was most prescient of you, and we are most grateful for what you saw then.
Thank you.
Alan began his fund after, I guess you started out kind of as a technologist. You went for DEC for 5 years, Digital Equipment Corp.
Correct, yes.
And then you got into the investment business by bits and parts, having spent much time at Sanford Bernstein, and then in Appaloosa,
Correct.
Famed hedge fund, before founding your own famed hedge fund. That was in 2001. And what struck me, Alan, reading one of your latest letters to your limited partners, was you speculated that had you begun in 1998, it would have been a very difficult first couple of years. So could you tell us why?
Yeah, 98, 99 would have been difficult. 2005, 2006 was difficult, and 15, 16, 17 have been difficult. And what do those times have in common? Well, the tech bubble was a very difficult time for a long-short investor. You had to essentially get on board of these stocks that were expensive, getting more expensive while everything else was selling off. The reaction to the burst of the tech bubble, which was around the time I started my fund, which was a great time to be a long-short investor, you had this response from Greenspan at the time.
What we're showing you here on our YouTube channel is just the tip of the iceberg. No matter where you are in your financial journey, whether you're a beginner just looking to break into the market or a financial professional looking to up your game, Real Vision has something for everyone. Every day, our team of expert journalists provides in-depth analysis, written reports, access to live streams, and access to our community, The Exchange, where you can interact with people just like you from all over the world. For just $1, you can unlock all of this and more at realvision.com. Try our Essential tier. If you like what you see, it's only $20 a month thereafter. So click on the link in the description, go to realvision.com, and see what you think. We look forward to seeing you there.
Which was around the time I started my fund, which was a great time to be a long-short investor. You had this response from Greenspan at the time, the central bank, to try to cushion the blow of the bursting of the tech bubble. And what that really set up, that period, in my view, was the housing bubble that ultimately, before we got to the housing bubble and the ACE security that I mentioned to you at the time, the effect of what was done with interest rates had sort of pinned housing prices higher, along with the behavior of mortgage companies and sort of this intersection between the appreciation of home values and the lack of need to have any equity in mortgages. I mean, this whole thing was sort of coming together, and we're fortunate to have investments in housing companies that were seeing lines of people show up to bid for tracts of land in Florida.
This is where we have different lines of work, Alan, because in the years 2001, 2, 3, 4, 5, 6, Grant's Interest Rate Observer deplored these queues of people lining up irrationally and uneconomically to buy the houses, the makers of which you were long.
Right.
Well, it takes all kinds of people to make a world.
Yes.
I'm not
we also got long subprime lenders.
Yes.
And we got to know them well, and early on, it was clear that this was going to be a booming opportunity for subprime lenders. You were taking debt that was costing folks very high rates on credit cards and pulling equity out of homes, and so that was a natural arbitrage that created this big opportunity. And then you were using subprime to fund the purchase of second homes, driving up real estate prices. And it was actually at a breakfast with a company coming public that I ended up investing in, where I asked a number of questions about how these loans work. And it became very clear that the whole key to those loans was home price appreciation. And at that breakfast, I kind of logged this view that, wow, when this turns, it's going to be a very significant credit event.
Let me, if I may, just interrupt to observe how unusual it is for someone who has been long a big theme to turn around and successfully to change views and become short successfully that same theme. It's done sometimes at a bar in recounting fabulous, fabled stories, but rarely in real life. Tell me about the kind of the intellectual flexibility this requires. When did you decide to kind of jettison the bullish view on subprime?
Well, it was a matter of first developing an understanding of what was going on and how this reflexive process, classic Soros reflexive process, was interacting with the real world. And it was very simple, easy credit, drive up home prices. The fact that home prices was going up was making credit easier. And so it was a matter of how long that would play out and when it would end. We had the patience to wait, and we made some money on the long side of some of the subprime lenders during this period. And it was really gaining the knowledge of what these CDOs and CDS securities were that was an eye-opening,
most helpful
opportunity for me.
Do you recall the subprime lenders that you were long, that you owned?
American Home was the one out of California that was the primary long investment. I think it was American Home Mortgage. You're taxing my memory now, but great group of guys that were brought public through Friedman Billings Ramsey. One of them became an investor in my fund for a number of years. And they also, by the way, tried to talk me out of shorting these mortgage securities. And we have lots of math that will tell you that this stuff can never break, and you're going to lose money. Don't short them was sort of their point of view at the time, but we did anyways.
Recall how early you began this?
Well, we were dabbling.
I say early, just perhaps it was at the peak.
No. We started in 2006 getting involved. And I actually think I read an article in Barron's that was buried somewhere that somebody talked about this idea. And then we got connected to the folks at Deutsche Bank. And I'm forgetting the guy's name. That was the primary driving force behind the idea that these things were going to quote unquote blow up. And started to dig in. At the time, we thought we had to understand each individual security, do the research on those securities, and make sure we were shorting the weaker of the bunch. And it turns out that was sort of a wasted effort. You could have just shorted the indexes because the whole thing unraveled in such a spectacular fashion. But But one of the folks that I spent some time with during that period was Kyle Bass, who was starting a fund himself. And we talked on the phone one day about this idea. And Kyle grabbed it instantly and decided to dedicate a fund to this idea and leverage it, and really did spectacularly well. And it was really working with Kyle that helped me get the courage to go from a small position to what I thought was a huge bet, which was 1 times capital. Now there are some guys that went 5, 6, 7 times capital.
1 time sounds kind of okay.
Well, what allowed you to go to 1 times capital in that short position was that you had a finite drag. It was a couple % per year. Average life of those things was 3 or 4 years. So you knew what your loss would look like, and the asymmetry of that trade was spectacular, something I don't think I'll ever see in my investment career again.
Well, Bitcoin only goes up.
Right. Yeah, that's
different,
something I don't understand well, Bitcoin. But anyways, that opportunity presented itself, and we scaled it up, and we've tended to have our best performance opportunities during the periods of adjustment, turmoil, and so forth. And getting back to your original question, 01, 02 were the best years that we ever had as the tech bubble distortions were being corrected. Back then, you could buy any small cap company at 8 to 10 times earnings, while Cisco is 70, and that collapse of all that stuff created great opportunity.
Now, were you short the tech stuff as well as long the value stuff in 2001 and 2?
Not short exclusively tech, but there was plenty to short. And short more of not the high quality stuff, but some of the garbage that had floated with the high quality stuff.
So you just started the fund.
Yeah.
And it must have seemed as if you had walked into the world of the land of Oz, right? So,
yes.
Was it first year's up 40% or something? The second year it's kind of ditto. Yes. Did you ever think it would be this easy?
We made money almost every day. I hired a guy that came in 6 months later as my first analyst. He's like, "This is great. This is like a money machine." Right? We just made money all the time, and it was just good timing on my part. I was very fortunate to start in that window. And then 07, 08, we did very, very well because of our understanding of some of these dynamics in the debt
07
markets.
especially was standout, no?
Yes.
In fact, I think out of the first 9 years, there was perhaps one in which you did not match or handily beat the S&P. Maybe 2006 was that year.
Correct.
So the first 8 or 9 years was like, easy.
Yeah. No, it was a good opportunity set. But what's happened, with each of these cycles is that the central banks have sort of doubled down.
Yes.
On trying to eliminate an economic cleansing, a credit cleansing, and this cycle we're in now, I think, is really I sort of think of it as the everything bubble. I mean, it started as a sovereign debt bubble, which was engineered by the Fed. It's sort of the ultimate experiment in trickle-down economics.
Are you talking about the portfolio balance channel?
Yes.
Yeah, trickle down, really.
Yeah.
I just wanted to attach a dignified name to it.
Yes. Well, no, I had a conversation with someone who is now on the sell side, who was at the Fed at the time. And I just wanted to sort of get a sense for what they were thinking and how they had the courage to do this. And it took a lot of courage. And by the way, I think it was the right thing to do for a period of time.
So I'm going to interrupt you once. Okay, yes. So Ben Bernanke, PhD, the chairman of the Federal Reserve Board.
Yes.
Writes this self-exculpating memoir called The Courage to Act.
Right.
The Courage to Act. How much courage would it have taken not to act, to have allowed these distortions and these grotesque mispricings to sort themselves out and to rely on the price mechanism? That would have taken some courage, right?
I agree.
So before you were interrupted, you were saying...
Yes. Well, we live in a fractional levered economy, right?
Yeah,
a fractional banking system. So fundamentally,
it have for a long time.
So they made a decision, let's say, to act in a way that was bold. But in interviewing and talking to this former Fed research person, he basically said, look, raising the Fed funds rate up and down throughout history affects asset prices. This is no different. What we did here is just sort of, extending our policy, which is remarkable to view it that way. But obviously we've driven sovereign debt prices to levels that don't make any sense, particularly in Europe. And that's driven now the value of everything else: equities, sports teams, art. It's been an asset price party.
Well, okay, so you are, and I know this because I know you, and also I've read your literature. So I know that you guys do fundamental bottom-up research,
yes.
and you're also macro aware. I think
Yes.
that was a term maybe in the literature.
Yes.
So the macro awareness, it seems to me, did it not at one point prod you to get long the everything too? I mean, have you ever been tempted just to climb on board this thing and just levitate?
Well, I think there was a period, 2012, 13, 14, where I felt we were in a sweet spot from the standpoint of the liquidity in the system driving asset prices, right. and we did very little in terms of hedging the portfolio other than our core long-short positions. I really became macro aware as a result of sitting with the best investor in the world, David Tepper, for 5 or 6 years. And David used to joke about how I should have paid him to work there, and it turns out that that's actually true. I should have paid him to work there, and all the things I learned there have helped me throughout. But I guess our view and my view has been, in terms of like sort of how this chapter ends, is that eventually we're going to run out of the most important resource to corporate America, which is labor. And so I've had a view since 2015 that we will enter a period where we have a normal classic business cycle. And what happens in a normal classic business cycle is labor gets tight, wages go up, the Fed starts the process of slowing the economy. And usually that ends up with a recession. It may be a mild recession, it may not. What's been remarkable here is that we used to think 6 was the Nehru level, then we argued it was 5, and here we are at 4% unemployment, and we're convinced that there is no such thing as the Phillips curve any longer. And the benefit of being a micro investor, as we are, is we're talking to companies. And we know in our conversations with companies that companies are struggling with labor. It's very real, and it's going to come through in the government numbers. And
Can you give us a couple of real-life examples from the companies you know so well about what they're finding in the way of skilled labor, unskilled labor, or wages actually going up? And if wages are going up at the micro level, why hasn't it not registered?
In the government numbers? Yeah, I struggle to answer that question. I've read. I'm not an economist. I like to keep things simple. I've read a lot.
Explain your success in life.
Well, I've read a lot of theories about age cohorts and the baby boomers staying on longer, and that as they've dropped out, that's been a depressant. And I've seen a lot of different cuts at it. My view is that, trying to keep things simple, is it's really just supply and demand, right? The supply of labor is at a point where historically you've had wages in the plus 4% and above range.
Can you give us? I interrupted you and myself to ask about ground level sightings from the companies you know about.
Yes.
Can you give us a real life case?
Well, probably the most glaring. We saw what Walmart announced a year or so ago, which is we're going to pay people more.
Yeah.
We have to pay people more, and that's a tough formula when you're competing against Amazon and you have to pay labor more. But that's one area where you've seen pressure. Now, there aren't many people working in retail, so on a broad economic basis. Well, if you really look at retail numbers post 2008, the numbers cratered, and they never really came back that much in department stores and so forth. But health services is another area where there's been a lot of pressure, trying to find nurses and people to work in hospitals and nursing homes and all of those arenas. And there's been an ongoing issue in STEM and technologists where we just don't create enough of them. Now, an interesting wrinkle in our economy these days, which is affecting the UK in a big way, is the UK went through Brexit,
Yeah.
and they have a supply shock of workers. So you're seeing wages move up in a number of cases, a number of companies missing earnings in the UK. And we don't have the same Brexit kind of dynamics here, but certainly we've become a less friendly country from an immigration standpoint post-Trump. And one would think these pressures will work their way through.
I saw something quoted, indeed, it was, I think, in one of your letters, and that is that the Duke survey of chief financial officers shows that for only the second time in the history of that survey, I'm not sure how far back it goes, but for only the second time in the survey's history, do so many of the CFOs who were polled agree that labor is the top problem they face.
Correct. And I think, keeping it simple, I think you've had a period where you haven't had a lot of wage increases, and I think companies are fighting it. They're not getting a lot of productivity. And my concern is that when it turns in a nonlinear fashion, and we could find that the neighborhood actually is closer to 5 or 6% on the way out of this, which would mean the Fed would have to do a lot more.
Neighborhood meaning the natural so-called rate of unemployment?
The rate at which supply and demand drives up wages. In other words, it hasn't happened, it should happen, it will happen. As it happens, the markets are going to then decide, well, how long is it going to take? How much damage to the economy will we have to do to work our way out of this?
Well, we've had many such business cycles in which labor is redundant and then scarce, and then it balances, do supply and demand, but at a higher level of pay. This time is different, perhaps, in this respect that interest rates at the beginning, what may or may not prove to be the tightening phase of the labor market, interest rates are at historic, indeed millennial lows.
Correct.
There's still, I think, 10 plus trillion of debt in Japan and Europe that are quoted at nominal yields of less than zero, which is
insane.
Not really high.
Given where those economies are, right?
And one would expect that if interest rates are going to turn, it might be a kind of a noisy and dramatic turn. No, are you plugging in the interest rate aspect to this as well, the bond market side of things?
Well, the thing that concerns me the most about this sort of overall technical setup, if you will, is that the reason people own bonds is they don't correlate with stocks. So if something bad happens in the stock markets, bonds rally, right? So risk parity is some stocks and a levered bond fund. It's been fabulous because that's been what we've seen for the last 15 or 20 years. Well, if we get a turn, which is just driven by a normal business cycle, and that correlation comes apart, who knows what happens? But there's a lot of money that's been dedicated to these kinds of strategies, whether they're vol targeting, risk parity. We're in sort of a spooky time.
Use this phrase, the setup, which I think is a wonderful way of expressing the notion of an overall context of things, how the forces are aligned or misaligned. And so many of those forces in this particular cyclical moment seem to be unusual, if not unprecedented. Certainly the nominal level and the real level of interest rates is one of those forces. The positive preoccupation with the efficacy and with the certainty of outcome of passive investing must be another, right?
Yes.
And the peace and quiet in the markets as reflected in readings in both the MOVE index, which registers bond activity, and the VIX index, which registers agitation in the stock market. Those things are at record or near level lows. So Alan, how do you see the constellation of these forces?
Well, we joke on the trading desk when we come in the morning, if the futures are down, like today they were down a bit this morning, we joke about what time they're going to go positive during the day, and usually it's after the Europeans, go to the pub or something, around 11 o'clock, by 2 o'clock they're positive. And I just mentioned this because it's it's very unusual and something that I've never seen in 30 years or so of doing this, that sort of nothing rattles this market. And I think some of it is this, the vol.
Now let's explain this.
depressed.
So volatility is now it's like a thing, right? It used to be stocks and bonds.
It used to be observed based upon how options are priced.
Right.
Now it's actually a source of income.
Right. It's like an asset class.
a bond.
Yeah, right. But it's movement. It's kind of capitalized movement, right?
Right.
So I mean, as a paid-up subscriber to Grants, where's the camera? You perhaps noticed the Frank Brosen's thoughts on volatility. And Frank, like you, has a technical background. Frank studied aerospace engineering at Princeton, and he likens these volatility readings to as they move up and then fail. He likens it to a liftoff, to a rocket liftoff. So it's not quite got enough thrust.
We haven't had the liftoff yet. Yeah.
But he says that just you wait. I'm 71 years old, Al. I can't.
Yeah. You look great, Jim, for
Thanks.
71.
Yeah, but we can't. I mean, tick-tock, right? Let's get on with this.
Yeah, I mean, it's so I'm going to tell you a little story, which is interesting, which is suggestive of the idea that we're pretty late in this TikTok game.
I'm ready.
Well, a friend of a friend asked to come see me, who is a high net worth broker at one of the investment banks. And he said, look, I know I can't help you in the stock market because you're doing your own thing and you're fun, and I get that, but maybe we can help you with fixed income. I said, sure, come on by, let's talk. He comes in, and I asked the question, so what are people doing for income? And he said, we have this great product that sells vol. And I said, oh, how does that work? And well, very basic explanation, selling puts, selling calls, straddles, blah, blah, blah. And I said, what happens if the market goes down? And he said, well, there are ways they protect against that. I was like, okay, well, can you, and I just was very curious, right? So I said, send me the documentation. So he sends me the brochure with all the legal details and so forth, and there's really no protection. They're just selling vol and collecting income, which has been successful.
When you sell vol, what do you do exactly? Do you sell puts on the VIX index?
Yes.
Okay.
And different tenors, and there are strategies that will sell vol at a level and then buy vol further down to try to dampen potential, crash risk and those kinds of things. But essentially, you're just collecting income by being
selling
the house,
puts, yeah.
Selling puts. So a few weeks later, another investment bank invites me to come and speak to some pension investors. And they were taking them to Washington to sort of hear what was going on down there, and then they brought them up into New York, and I was sort of at the end of the day, talked to a hedge fund practitioner kind of thing. And I sat there and I told them the story about how this guy was trying to sell me vol, expecting some kind of a reaction from them.
So?
And it was kind of, they were just kind of very stone-faced, and it was towards the end of the day, so maybe they were just tired. But as I'm walking out of the room, the host says to me, well, this was great. I know they enjoy this, but I want you to know that everyone in this room is selling vol. And I said, really?
This is a group of
pension funds, large European pension funds. And he said, yeah, but they have this strategy where when you get a sell-off, they sell more into the so if the VIX spikes from 10 to 15, you sell more. And then you continue to have this tremendous monthly pattern of income. So, as I was walking out of there, I thought, my goodness, the central banks have succeeded in pushing people out on the risk curve. They're taking people that are managing the pensions of state pensioners, and they have them in negative earning sovereign instruments. Right. And now they have them, they're so desperate for some yield, they're systemically selling volatility, which is remarkable.
You have to believe these are the same guys who were buying Ace Securities, HEL, whatever it was in 2006.
Yes. Yes.
Well, it'll, as we say in the journalistic trades, Alan, it's going to make some great copy.
Yes.
I'm not sure about the pensioners.
Yeah. Well, look, it's when, how, what the impacts are. It's unknowable.
Yeah.
But I think in my view, we're because of the unemployment rate being where it is, and what I think is already happening with wages that needs to catch up in the government numbers, I think we're very close to the point at which we have a shift. And people in the markets, you talk to guys, if I bring this up at an idea dinner with some hedge funds, they all look at me like, are you crazy? We're going to get inflation? The Fed's going to cause a recession? People have said, well, even if they feel like they have to cause a recession, they don't have the stomach for it, whatever the problem is. What happens in the markets is that the markets lead the central bank.
Right. The central banks might not be in charge of events, right?
Right.
I mean, my goodness. I mean, I think I'm a bit older than you are, but I remember so well in the 1970s, and people were openly scornful of the Federal Reserve, its capacities, its judgment, and its personnel. There was Arthur Burns, who was said to be a toady of the White House. There was G. William Miller, who was President Carter's first pick, a man of some inclination to get along with things, and who was, at least after the fact, was seen to be a great accommodator of inflationary tendencies. And then along comes Paul Volcker in 1978, I guess, and he was regarded as a Treasury Department lifer, a job's worth, and not especially courageous. And he had to, so he comes in, he announces his regime on October 6th, I think, 1979. The Fed is going to strangle inflation dead by choking off the supply of bank reserves. It was October 6th. The gold price proceeds to go for whatever it was, say $300 to $1,000 in the face of this threat, which in fact turned into action. And the long bond that day, when he spoke, or on the eve of his speech, was a 9% number, and it peaked, did the yield, in the end of September 1981 at 15%. So those things are measures of the low estate of the Federal Reserve. And now, after the central banks of the world, not just the Fed, after the central banks of the world have bungled the biggest economic event in the lives of the PhDs who run the research department of the central banks, 10 years after that, the Federal Reserve and its brethren the world over enjoy unprecedented status and powers.
They control the markets.
Yeah, they do.
In the view
and the weather.
And the weather.
Everyone's got a weather app. The weather apps are supposed to be scientifically calibrated. They got all these big data observations on cloud patterns and temperature gradients and the rest of it. And yet the forecasts constantly change because the circumstances change. And clouds and raindrops aren't sentient, right? They don't change their behavior because something they see on CNBC. So I think volatility is not getting its respect, nor is doubt generally, skepticism down.
Right. And the irony of where we are in the economic cycle and where we are with unemployment is that faster economic growth just precipitates the need for the alteration of policy in faster. And we went from a regime of fiscal tightening, essentially regulatory tightening, to now we have a regime of let's cut taxes and let's loosen regulation right at the point where the resource is depleted. Employment.
Now, have you got a mental timeline about when you might relinquish this thesis if it doesn't work out? I mean, one of the things that makes you such a successful investor, of course, is your lack of dogmatism. And I know that you are prepared to cut back on equity hedges when the market goes up in your face. You're not in there to make I'm in the business of making statements. You're in the business of making money. So when do you kind of pull back if it is not working?
Well, we've done a good job of being non-correlated this year. So we've been too negative, and we've been seduced by how cheap vol is. So the nice thing about protecting a portfolio of long equity is that the volatility instruments allow you to do that at a very low cost. So we have.
But also, you have the good feeling of funding European pension funds.
Yes, exactly, exactly. So it's a little altruistic. But so our hedges are relatively light. Our gross long has come down recently, and we have a short book of ideas that are researched on a micro basis that will protect us quite nicely. I think the important thing for me and for my investors is that we have the playbook. We're ready. We understand these dynamics. We're prepared for these dynamics, and I think once again in a period of turbulence we'll do quite well.
Hedge funds are not to be confused with Vanguard cycle.
Right.
So the money is going to Pennsylvania, to the Vanguard headquarters. Are you seeing this yourself? What do you hear from your own investors about the seemingly inevitable updraft in things, the costless opportunity to participate in that updraft, and the lack of any second decision about doing so?
It's really hard for my investors. I feel for them. Many of them have a requirement, liability that needs to have a certain amount of annual return, a certain amount of income, and they don't generally think about these bigger picture issues. They try to have non-correlated baskets of things, but the bottom line is if you're trying to protect capital, if you're cautious and you underperform, eventually you're fired. And the money flows to quantitative funds, risk parity funds, to Pennsylvania, to low cost index funds. But that's cyclical. And I remember 07, 08, everyone was saying it's really dumb to short stocks. And long only funds were pumping up.
It seems so long ago, and now in retrospect, it seems like such a wonderful thing to have done. You forget what the negative karma was like. But I so remember the summer of 2007 was brutal for the skeptical tribe, the ever-diminishing skeptical tribe.
Yes.
Sounds like whining, doesn't it? Okay, I'll stop that.
Well, the cycle will turn.
Okay, you said cyclical.
Yes.
Is there of course, there's a possibility. How do you reckon the odds that there's something secular happening?
In terms of we'll never have volatility again, or we'll never have another business cycle?
The business cycle has been altered through the unprecedented exertions of these central banks.
I think the probability of that is near zero.
And let me try this one. The Hoisington management people who have done such a good job of owning the long bond and not selling it, that's the most important part.
Right.
That have developed a kind of a variation on the Irving Fisher, is it Irving Fisher? The great American economist whose last name is certainly Fisher and whose first name may or may not be Irving. I'm drawing a blank at the moment. But he spun out the debt deflation theory of debt in a famous essay in 1933, did Fisher. And so the Hoisington people have updated this, and they have contended that the accumulation of non-productive federal debt, that is debt not going to build new infrastructure, but rather to facilitate consumption, constitutes kind of an oppressive weight on the shoulders of enterprise. And it is this weight of debt that is stalling this economy, and that the more stall there is, the more debt there is, and the less likely there is the business cycle reverts to something familiar.
Well, under that scenario, I guess the thesis, I'm not smart enough to fully grasp when too much federal debt.
I feel like I'm being set up here.
It's an interesting theory. I'm not smart enough to give you a point of view whether that's right or wrong, but you still have an issue with a labor resource that's finite.
Yes.
In an economy that's growing. So, perhaps they would argue you get stagflation. I guess they're arguing that a modest increase in Fed funds rate will invert the yield curve and the economy will collapse. Yeah. I don't know if that is right or wrong. It could be that the economy keeps rolling for a while into higher rates, but either way, trading at the multiples we're trading at, with implied volatility where it is. I mean, there's a huge disconnect between that theory and how stocks are priced today. And that has to get
So in a
rectified.
way, as I mentioned to you before we got started, you're not bearish by temperament. You're skeptical by temperament. Perhaps maybe I'm saying something that is not strictly true, but it seems to me that your funds, plural, are in the business of anticipating discontinuity and disruption more than betting on direction and outcome. No?
Correct.
Is that possible?
Correct. We view our primary job as to protect capital. And we've done a very good job of that. And when you don't, in 2008, when you're flat, down 1%, it's a heck of a lot easier to have a nice long-term compounding record when you get re-engaged in 2009. And that's what we view as our job. This cycle has been tougher for us to manage because this move to lower and lower unemployment without really much of a wiggle in wages. Now it's happening. It's just happening in a very tame, slow fashion. This is not something we anticipated.
Long-term investing reminds me a little bit of long-term baseball. It's a very long season, and Aaron Judge, when he was accepting accolades on getting Rookie of the Year from American League, was saying that in spring training, I guess last year, he had been talking with the aged and hoary veteran Carlos Beltran, who might be all 40 years old, and Beltran was saying, look, kid, over the course of a season, these things average out, that it's reversion to talent, it's reversion, he didn't say it this way, but over the course of 162 games, the ups and the downs are neutralized, and you're left with talent and output.
Yes.
Now, your funds have been up 12% since inception versus 6% in the S&P. Most of that outperformance is in times of disruption.
Correct.
So, however, I notice also that you have a credit opportunities fund that you began most felicitously in April or something in 2009.
Correct.
And that's delivered 15% since inception. Please tell us about that and about what direction opportunities might lie in credit.
Well, that fund is closed. We started that fund for one simple reason: we could buy bulletproof AAAs at 60 or 70 cents. That our credit analysis suggested that you just literally couldn't break them. They couldn't lose money in any realistic economic scenario. We told our investors when we bought them. By the way, we didn't raise much money for that fund because people said, "Well, how can you do that by yourself or with one other?" I hired a guy named Kevin Lemmer, who was a fantastic credit guy, to help me. And what we told investors is, we're just buying this stuff at 16, 70 cents. We're going to hold it until the return has worked its way out of it. It'll be a double in 3 to 5 years. It happened to be 4 years, and we sold it. And we're done in credit. So we look at credit when credit looks like equity.
Yes, right.
And has equity-like returns.
Well, maybe the credit opportunity fund will open again in our lifetimes. I bet it will.
It could. It could.
So here we are in, is it 2017 still?
Yes.
Time does seem to march on. Okay, so I would like you to, if I could, to ask you, just for the sake of illustration, so people know how you approach a security, give us kind of a not overly granular, but still a look inside the thought process of one long, and perhaps without naming it. Just give us a ticker. Don't name the name, one short. I know how sensitive the shorts are out.
I know you want tickers on the short side. And for the record, I said I wasn't going to do that before I got on TV, so you're trying to embarrass me into it now.
Well,
but
jolly you into it, Alan.
So our largest, the easy one is our largest long position. It's a company called ASML Lithography. ASML Lithography is sort of the arms dealer of the semiconductor business. So if you believe in driverless cars, artificial intelligence, video blasting into devices, all this stuff that people are excited about, you have to buy their stuff. There used to be 3 companies that made lithography equipment. So lithography is simple. It's a laser through a lens to carve the line into the semiconductor, so the silicon, to create the semiconductor. So we used to have line widths that were like this, and now we have line widths that are going down sub 10 nanometers, and we're talking about getting to 4 nanometers, which is, I think, 2 or 3 atoms wide. And so it used to be ASML competed with Nikon and Canon. They kind of split the market. And then Canon kind of dropped out because they couldn't handle the physics. And now this current generation that's being implemented called EUV, Nikon has dropped out. So this is a 100% market share company.
Huh.
So the units used to cost, the current generation costs 50 to 60 million per lithography unit. EUV is going to take that cost up to 150 million plus. The next generation of technology, which gets you to the 4 nanometer level, is going to be $300 or $400 million per machine. So unlimited pricing power, complete monopoly, and the key to Moore's law. So what are the earnings like? Why do I like the stock? They're earning around €6 now. Those earnings will be 11 to 13 euros by 2020, and they'll be growing rapidly into the middle of the next decade.
What is
stock,
it? How's it valued?
Stock is 170. So on our 2020 number, now they're sold out of their capacity for 19. They can make 30 units. The customers could use 45 units. So they're trying to, so their earnings are a lock, is what I'm trying to tell you. And you're paying sort of a mid-teens multiple on 2020.
Now, what are they doing for labor?
Well, that's the
Are they
beauty
constrained?
They have more PhDs and physicists, but in terms of actually assembling this equipment, they're not constrained.
Now,
and they have enough pricing power to
yes,
deal with any constraints they might have.
Now, CapEx, are they?
They're not heavy CapEx, or they had to buy a laser company in order to get it's an assembly business.
Yes.
Primarily, so they're assembling lenses. They have a joint venture with Carl Zeiss for the lenses, and the lasers. It's R&D intensive, not CapEx intensive.
Is there any? I mean, what's the wrinkle, Alan? I mean, is it? I know the balance sheet's lousy, right?
No, the balance sheet's fantastic. They buy back stock with excess cash flow. The misunderstanding or the miscue people have with the company is they think that this has historically been a cyclical business. So you have these semiconductor cycles, and we certainly could have a global economic slowdown that would cause less spending. But the key, so people will look at the 2020 earnings number of 12 to 13 euros and say, well, shouldn't it be a low teens PE because that's the peak of the cycle? And so what I think they're missing are two things. One is that China is just now starting to build a semiconductor industry on their home turf run by their companies, and they'll be buying the current generation machines. They're not going to buy EUV or the next generation machines because they're just getting started in this business. And that provides a baseline that keeps the old stuff steady. Right now, Wall Street models have the old stuff falling off. And then the other misunderstanding is how rapidly the ramp to the next generation technology will come following the EUV wave. So we don't view it as a peak 2020 number. We view it as 12 to 13 euros and growing rapidly.
Yeah. Wow, sounds pretty sweet.
Yeah.
Hey, tell me. Okay, well, fine. We'll skip the short idea. But tell me this quality.
On the short side, there's so much disruption going on in the world that there's lots of opportunity.
Right. Are you finding more opportunity on the short side or the long side?
Well, you can scale the longs much more easily because the dynamics of a company like ASML can triple over 4 or 5 years, where a short can only go down 100%. And if you're lucky,
some of them actually do up though.
And well, they get crowded and they go up, so you have to size them appropriately. So we risk manage the short size. So we have many more names in the short portfolio, but we're coming up with ideas on a daily basis. I mean, there's a lot of opportunity.
How big do you let something like ASML get in your portfolio?
7% currently.
Yeah. Is that about the biggest single name you have?
Yes.
And will you go to 10 on a name?
Yes.
Let me go back a little bit in your career and ask you, back when you were at Appaloosa and before that at Sanford Bernstein, what did you learn that you have had to unlearn, given the way the world has evolved with respect to central banks, with respect to the expectations of continued radical intervention, with respect to the nature of what we call the A.W. Jones model after Alfred Winslow Jones, who was the the father of the hedge fund. What have you had to unlearn from your early training?
I think the most significant thing in the past couple of years is that I used to be able to look at the markets and they would tell me a story. You could look at sectors and how they're trading, healthcare versus industrials and financials, and there was information that came from the market. And the way I think about investing is risk, reward, and probability. Simple model, and probability is really what you know and what you don't know. And when you apply that to the bigger picture, you need the market to tell you when you're on the right track with different things. And the last couple of years, the sector movement, because of sector-based ETFs and the violent rotations in and out of sectors, I've had to unlearn that there's information in that. There often is no information in that. It's just, some machines decided that because of something happening somewhere, they want to plow into, one area, and they plow out and they plow into another area. So you have to sort of desensitize yourself to some of that kind of movement.
Looking down the list of your personnel, I did not see a single named machine. Like you didn't have an AI thing called Judy, for example. Are you partaking of the AI revolution?
No.
No?
I think businesses are priced on cash flow over the long term.
What's that supposed to mean?
And so the short-term stuff that what the machines are doing seems to be pretty impressive. There are some guys that are doing a really good job with that. What I tell my guys is, look, these machines are trying to figure out who's got the press release that's taking earnings up, or who's beating earnings, or whatever they're trying to do. Yeah. So we need to understand lithography, ASML's position in lithography, and what the next several years are going to look like because of their technology. And if we're right, the machines will just love this story, all the way along, and they'll be oriented towards, that more short-term trading stuff.
Now, I ask you what you would unlearn again from your earlier experience. What are the lessons, perhaps at the altar of David Tepper, have you learned that have stood you in good stead through all these iterations of cycles? Are there any evergreen things about investing that stand the test of time, even in unique times?
Well, probably, first of all, David is an exceptional talent, the best there is, and I'm lucky to have had the opportunity to work with him and talk with him since then. And I'm no David Tepper, but David said some funny things. He would say, I'm too stupid, or know what you don't know. And it's sort of this idea that you got to distill things down to simple, understandable facts, and that's a very hard thing to do. I mean, his ability is to look at the intersection between credit, whether it's sovereign credit, high yield credit, investment grade credit, equity, and then to look at it across multiple markets. He's exceptionally skilled, but taking 10% of that away has helped me a great deal in terms of navigating periods of risk, and that's my primary function. That's why the fees structure makes sense for what I do. If we can manage risk, that's not a common trait that you can get in an index fund.
One observation I have on risk speaks also to your observation on the seeming lack of information in market action. We know, so you might have seen this in grants, but early September, Toys R Us has an issue, had an issue 7 3/8 of 2020 or something, 2019, a near-dated note that was trading at about 95 cents on the dollar. It spent the whole summer at 95. And come intimations of Toys R Us's distress and nothing doing, is still 95 cents on the dollar, and suddenly, Toys R Us files. It's a chapter case, and the note goes from about 93 or 91 or whatever it was to 20, like that, like it dropped off a cliff. So there's no discounting there. There's no indication of prescience, let alone, or even of sentience on the part of the people who own it, right? It just goes away.
It's just in a portfolio.
Well, it's in somebody's portfolio.
Yeah.
Perhaps that person doesn't have a name because it's a machine, or it's an index fund.
Correct.
But if there's no information or little information or less information, at least in credit, and if credit is kind of the most consequential price, interest rates the most consequential prices in investing, don't we all live in a kind of hall of mirrors?
Absolutely. I mean, the whole case for the market today is that it's cheap relative to rates, and rates are priced in a distorted fashion. Why is the yield curve inverting? There's a lot of debate about the yield curve inversion, and what is that signaling? Well, if German 10-year is 40 basis points, it's hard for our 10-year to get much above 2.4, or this level it's been hanging out at. So I think that's what's so disruptive about people understanding that business cycles can still happen.
Yeah. Well,
Because then all of a sudden it's,
it happens.
Wait a minute, maybe it doesn't matter where Germany is.
Yeah.
Maybe the business cycle matters.
Well, Alan Fournier, it's been a delight. And,
Thank you, Jim.
And disruption is the theme. I wish you all that you can handle.
Thank you very much. I appreciate
and,
that.
I am so grateful that you were here today. And I don't know, just keep on doing what you do. I wouldn't change a thing if I were you, Alan.
Thank you.
Okay. Well, that was Alan Fournier, and I am Jim Grant. And thank you for being with us. Alan brings not only a keen intellect and also 30 years experience to the business of buying low and selling high, but he also has a very, very seemingly heretical notion, which is that supply and demand will yet have their say. Well, I'm all for that. For Real Vision, I am Jim Grant, and thank you for watching.
What's with the bow tie?
I can't help but notice that not many people get the message that you have to wear a bow tie. You have to dress like you mean it, right? You can't walk around like in jeans or sneakers or stuff. No, you guys are cool.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.